It is not easy to predict crypto prices. There are simply so many factors, right? There is the Bitcoin ETF, there is the levered instruments, the futures, there's also the government involved with regulations. So many different factors, they all have impact on the price. But I think we can actually narrow this all down just to two simple things. The first one is how much money is flowing into crypto. The second thing is how risk on are the market participants within the market. The nice thing about splitting it up this way is that we can actually see both the macro cycle, but also short term if we might see a bounce or a correction. We've got quite constant trading ranges, and I want to share this data here in this video. Let's first talk about swapping activity, or how much people are risk on or risk off in the market. What we've got over here is the stable coin dominance. So how much of all of crypto is currently in the stable coins. When this is high, it means that a lot of people are just in stables and not on anything risk on. So that's here at the top 19%. And when this is low, it means that a lot of people are already deployed in crypto and there's only 5% of stable coins. Just have a look at how nicely this correlates with Bitcoin. So over here, we've got a high in the stablecoin dominance. And the middle of November of 2022 was over here when Bitcoin was at its price low. So people are risk off means that crypto prices are low. The opposite is true when people are very much deployed in crypto, right? When they are not risk off, when only 5% of all of crypto is in stable coins. So for example, here in the middle of December, that was also the time when the Bitcoin price was rather high. So there's direct inverse correlation here, right? People being risk off and having a lot of stable coins on the sidelines means depressed prices and vice versa. And just based on that chart, we can say that in the medium term, when we look at the last 15 months or so, the market is rather risk off. So if we were to go down in the stablecoin dominance, prices for crypto should go up. But when we zoom out a little bit and we look at the last 2.5 years or so, there have been times where people were way more spooked as well, right? Now the stablecoin dominance is at 7% and the peak it was at 19. So many people have already lost in the last few weeks, especially the short-term holders lost. But we are not yet in a full-blown bear market where even the long-term holders start to get into the losses. So things could turn worse. We've definitely seen worse in the past. So that's factor number one, right? It's quite interesting to see. It gives us some kind of a range, right? If we suddenly crash down again in the stablecoin dominance and it's close to 5%, we might consider taking some profit. If it goes up and stablecoin dominance goes back to 19%, it might make sense to buy a lot. But then besides the swapping activity, besides the measure how scared people are, there's also the in and outflows from crypto, right? At some point, people deposit their money into the crypto ecosystem. So you transfer your funds to, say, Binance. Binance then sends that fiat currency over to a stablecoin issuer. The stablecoin issuer holds the funds and then creates tokens on the blockchain. And we can measure that creation of tokens. So the creation and the destruction, of course, when you withdraw funds. The nice thing about looking at those in and outflows of the crypto world is that there is not much volatility. The trend is pretty clear. So that's this chart here. This shows us how many dollars are currently in stable coins. And this is going up whenever you send your money to Binance, and it goes down whenever you withdraw your money from Binance. Since October of 2023, we are in expansion mode again, and we continue to see inflows into crypto. Now, the nice thing again is that there's very little volatility in this chart, right? It's very clear if we're currently going up or down. The not so great thing is that this is potentially a somewhat lagging indicator. So the Bitcoin price was at $62,000 and the stablecoin market cap still continued to go up. It only stopped going up in March of 2022 when Bitcoin already hit the 44K mark. So we already went down by 30% roughly. The same is true the other way around, right? Bitcoin already recovered quite a bit before the stablecoin market cap went up. So you went from 16, 17K all the way to 27K, an increase of roughly 80% before we saw money flowing in. And so the big question is, now that the Bitcoin price is going down, will after a while the inflows into crypto stop as well? If yes, we will probably be in a full-blown bear market. If no, we might recover from here. And so there are two forces at play now. On the one hand, the people that are already within crypto, they are rather risk off, right? They've got quite a bit of money in stablecoins. But the people that are out of crypto, that are in traditional finance, they still continue pouring money into crypto, potentially stabilizing the prices. It is interesting how the stablecoin adoption grew over time. So here's the stablecoin transfer volumes per day. There's continued adoption. There's more and more usage of stables. And when we look at the number of transactions in stablecoins, it's even more constantly growing. Now there is a bit of a caveat to that chart, and that is Tron. There are a lot of transactions on the Tron network, and I'm not sure how organic those are because they've got quite a large share of those transactions. And Tron tends to be not that large of a blockchain. So when we just remove those Tron transactions, that's actually what we see. It appears as if there's a lot of wash trading on Tron. Still, over time, we tend to see more and more stablecoin transactions. And the same is true for the transfer volumes. Again, it's much more volatile than the number of transactions, but there is some growth. There is one trend within the stablecoin market that I think is very positive. It seems like over time now, less and less of the stablecoin dominance is in Tether. Because the issue is Tether never made an official audit. We don't really know if USDT is 100% backed. It appears as if, especially in the last weeks, more and more usage of USDC is happening on chain. And USDC, right, issued by Coinbase and Circle, is 100% audited. Have a look at this. It shows us in the last weeks and months how USDC is taking over more and more market share of the stablecoin transfer volume. So that's this area here in blue. And this, I believe, reduces the systemic risk for crypto, right? The more usage of USDT we have and the less this is audited, the worse the situation potentially is. Seeing USDC taking over more and more, I think, is a positive development. Very often when I discuss altcoins on this channel, right, when I don't talk about the macro picture, when I look at individual altcoins, I share how I believe that individual altcoins can be quite a bit manipulated. Most people think that it's the small people, that it's the masses that impact the price. But especially for the smaller altcoins, it seems to be just a few whales that move everything. It's actually quite staggering. Once we look at the stablecoin dominance based on different wallet cohorts, as in how much money a different wallet holds, we see how skewed the picture actually is. Have a look again at the stablecoin market cap. What we see in dark purple are the wallets that hold at least $10 million worth of stablecoins. What we see in light purple is from 1 million to 10 million. So all the wallets that have less than $1 million only make up this fraction of holdings. When we then also ignore the 10K to 100K and you've got only stablecoins up to 10K worth, you're only dealing with that little bit of market influence. We can also normalize this to 100% over time. That's then how that looks like. So 55% is held by the wallets that have at least 10 million, another 20% for 1 million to 10 million, and another 15% for the wallets with at least 100K. So if you've got less than 100K, then that's the kind of market share you're moving with your transactions. It's really a big boys game. It's really the people with several million that dictate the prices. Now it's interesting to look at the stablecoin supply fluctuations and then overlay this to the Bitcoin price. There are particular points in time where it might make sense to dollar cost average harder into Bitcoin than during other times. When this is hitting blue or this line is especially low, we should potentially buy more. We've seen a purchase signal at 36K, another one at 22, another one at 16. And we tend to be buying always at those lows. Currently, by the way, with our current drop to 80K, we haven't seen this indicator flashing yet. Now, all of this data, all of those charts, it all looks quite complicated, but we don't really have to make it that complex. We can use very simple models, very simple approaches, and still those approaches tended to work pretty well in the past, and they might, to a degree, still work in the future. The simplest approach that I can think of is to just draw lines on a chart. So those are not straight lines, they are curved lines, but still, they're nothing but lines. There's nothing mathematical about this, there's nothing complicated about this, but still, have a look at how nicely the bottoms connect with that curved line. And the same way for the top, right? See how those tops align pretty well on that line. This is a logarithmic chart, so not a linear chart of Bitcoin, but it goes all the way back to when Bitcoin was just a few cents in the year 2010. And if we just take this hyper simple approach, we try to figure out what's a potential trading range for Bitcoin, then the upper bound is somewhere around 114K and the lower bound is somewhere around 40K. If you are so much exposed to crypto and you don't own anything else, that you would lose almost everything if we are now dropping by 50% in Bitcoin, then you probably should reconsider your allocation. Then you might want to buy maybe some gold, maybe some stocks, maybe a down payment on a house, maybe just have some money in a fixed deposit account somewhere. Now, I'm not saying that this approach will work forever. I'm not even saying that this will work just for the next cycle or for the next few months, but it's still interesting to just have this as another point to consider. It's something that did a good job in the past, and so completely ignoring it would probably also not be that great. I have a look at this. This is the market value to realized value Z-score. So this looks at how much are people currently in profit relative to the price volatility. So relative to how much the Bitcoin price is going up and down. If people are a lot in profit relative to the volatility, then we should be selling. When people are not in profit, rather in losses, and that also relative to volatility, we should be buying. And currently, we tend to rather trend down towards the average cost basis of the market. We should buy most when we are in the green area. If I have a look at this, this is the realized HODL ratio. So this looks at how much short-term speculation is there relative to long-term holding. And again, this tends to top out at similar levels, and it tends to also bottom out at similar levels. It's not perfect, as in the bottoms don't align exactly, the tops don't align exactly, but it does give us a range. And currently we tend to trend downwards, right? The momentum is rather negative. Whenever we have been high here, we tended to just go back down all the way to the green area. And if you ask me, this is the most likely scenario going forward. I think that history is more likely to repeat itself than completely changing all structures that we've already observed in the past. Human psychology doesn't change that fundamentally over time. You want to sell when everybody is hyped, when there's a lot of short-term speculation. You want to buy when it's only the long-term holders that transact in Bitcoin. It seems like the market has phases of heating up and slowing down, heating up again, slowing down, heating up again, and now it seems like we are slowing down one more time. Here a bit more of a volatile indicator, still it shows us quite good cycle bottoms and cycle tops, and it would have triggered the right buying signals, and we are not yet in buying territory. Now, why do those cycles even exist, and why do those indicators work so well? I've got a theory. I think fundamentally what's going on is that people reallocate within their portfolios, especially those very, very large holders, right? They've got tens of millions of dollars worth of crypto. They probably don't just have crypto, right? They've also got other assets. Now, what's happening is that when Bitcoin is going up and it makes a 2, 3, 4, 5x return, that then within a portfolio, those mega whales suddenly have too much exposure to crypto and they want to hold something else. So what actually matters is the reference price of the market. Are currently the main holders in profit or in losses? And if they are in a lot of unrealized profit, they might realize that profit. And when they are in losses, they might just continue holding because the allocation towards crypto is already low anyways. Think about it. It's similar to how you probably trade yourself, right? If you buy Bitcoin and Bitcoin goes down in price and you don't have too crazy of an allocation, you've got a reasonable allocation to Bitcoin, you might even consider buying more when it goes down, or at least you continue holding Bitcoin. So the selling pressure is pretty low for you when the price is below your entry price. The opposite is true when the price is rising, right? When it's going up and up and up, and suddenly the majority of your wealth is in crypto, and before you only had 10 or 20% in crypto, you might sell. So it's always about the reference price. At what price did you buy, and how much did then the price go up or down relative to your entry point? That's why we see those cycles. Have a look at the net unrealized profit and loss. When most people are in net unrealized losses here in the green area, that tends to be the time when the Bitcoin bear market is over. When a lot of people are highly in net unrealized profit, that's when the bull market tends to stop. So unrealized profit gets taken, unrealized losses tends to mean a great buying opportunity. And currently we are still in net unrealized profit. So we are not that low in Bitcoin historically. Here's an easier way to look at this. This is the reference price of the entire market. This is the realized price, and that's currently at 43,590. So once we fall below that, that's historically the best purchasing opportunity. You want to be able to buy those bottoms. If you are not set up in a way with your portfolio that in case we fall all the way down to 43K, that you can't buy at those levels because you're already overexposed, then you should probably change something. If you are set up psychologically, but also technically with your portfolio in a way that you can buy a lot when we are at those price levels, then everything is fine. It's simply about the trading ranges, right? It's simply about figuring out at what point in time might Bitcoin be rather heated and at what point in time might it be rather cheap. And isn't it interesting how this realized price, the 43K, how it also aligns with the lower band that we've got on this drawn chart, right? We already talked about 40K around here. Now there are two ways to approach this now. We can either just exit everything and just buy fixed deposit and just buy gold, etc. Or we can try to make money from those falling prices. Now I do the second thing. I try to bet on falling prices because I actually think it's easier to make money in bear markets than it is in bull markets. In bull markets we have to find the one asset, or let's say the few assets that make these massive returns. But still returns are concentrated in just a few assets. In a bear market, the majority of altcoins underperform Bitcoin. The majority of altcoins are going down. In other words, when prices are going down, we've got the odds in our favor. We can be pretty much broadly diversified. We can own all kinds of short positions. When prices are going up, we still have all the returns in just a few assets. And we have to be very, very closely following the market to figure out those assets early. If you want to know how I make money during times like this, if you want to know what kind of altcoins I currently short and how I short them and what kind of risk exposure I have, how I avoid getting liquidated and still make enough alpha, then feel free to check out the premium membership down below. It's thebitcoinstrader.com. The link is down below. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you in premium or see you again here on YouTube. Cheers.